Wall Street's biggest bears are telling us to sell right now. Markets are starting to see some bad returns, and of course, the Bank of Japan is meddling again in not only their stock market, but their currencies. What does this mean for us as traders and investors as we bounce off the key semiconductor zone that we found together this week? Well, in today's video, we take a look at the dark pool liquidity, what's going on in the options market, and most importantly, the data leading forward after seeing a historic high day in volatility. Join us as we cover stocks, commodities, and cryptos right now. Well, welcome back everyone to the Daily Show, and what a volatile week it's been. My name's Tom, and today we'll be going through the macro and the data. If it's your first time here, remember to subscribe if you want to keep up to date with everything this earnings season and of course, volatile period coming into the elections. First up, breaking news. According to the Bank of Japan, Uchida, they will not raise rates when markets are unstable. Funnily, they would say something like that considering they just raised rates last week, but it shows how weak these banks really are. And in general, the central bankers will do anything to try to keep these markets up. If you want to find out more about breaking news, click on the links in the description and pin comment down below and follow us over on X. But let's go into the storylines here. The data, what does it suggest happens over the next couple of weeks and months? And more importantly, whether we just saw a temporary low. And this is a great chart from Macro Charts showing a 1 month call put skew and how drastic it really fell off a cliff over on the Monday session, being up there with the Lehman crash, the flash crashes of 2010s, and of course the Greek crisis back in 2011 and 12. This was a serious event in volatility, and we have just witnessed history, and it puts us into a very interesting perspective because what tends to happen after a VIX hit this high, a absolute flash crash, or of course economic crash event? Well, it usually means capitulation, and you can see here the S&P 500 forward guidance for the next 6 months tends to be actually very positive. And you can also see that volatility can start and then pretty much start and generally be around for a little period of time. When we tend to see this type of volume, it can create double bottoming bases. It can also create instability in the markets for about a 2 to 3 month period. And that works for this year because, of course, we're going into a US election. It's going to be up, down, and all around. Make sure to follow along as we kind of break down all of this stuff together. Let's also talk about the VIX spike and how big it was. This was taken as of Friday by Charlie Bilio over on X, and you'll notice that it only has 23.39. We actually had a reading that was way higher than that pre-market, and it puts us into periods that we haven't seen since 2020 in terms of flash crashing. And really, it wasn't as bad as that. We can see the Bank of Japan is instantly going back on their word, instantly changing everything. Oh, we're going to try to make the markets great again. Yeah, well, of course, that's what they do. But eventually, yes, Japan will pop. We all know it's a big ticking time bomb. But at the same time, is it really going to happen right now? What did hedge funds do on Monday? Well, of course, they were buying. In fact, they were buying out of control. What you'll see, though, is the CTAs show a drastic change. And it's as we suspected, just as dramatic as we thought, and we'll show you that very, very soon. Equity risk premium as well, for the first time since 2023, ticked up. That's good news for equity purchases. And of course, the consensus continues to be very, very good on the expectations of earnings into the fourth quarter of 2024 and of course, 2025. Everybody's still looking at the small caps to drive this market through and the big caps to hold on. Now, most importantly, NVDA earnings is coming up in the next couple of weeks. That will be a blockbuster, not to be missed event. It is going to be the biggest day on the markets that we know is coming, and you'll want to be on top of that one because, of course, if that misses, things could get very volatile indeed very quickly. Speaking of volatility, we know based on this chart, which helped us to kind of define the bottom on the Monday session, that we hit points that we don't usually see. And in fact, every single one of these points, except for the double dipping event over here, over the last 2 years, has been a temporary bottoming level for markets. So again, the odds are good that we probably did see the bottom. Another point I want to really kind of talk about here is when we look at this Morningstar LSTA leveraged loan index default rate, it's not exactly going up. Now, you will see some loans and some defaults going up that look pretty worrying. This one is quite important though. Usually you want to see this on the decline for being in a positive kind of environment. we're not seeing it on the increase, which is when you tend to really start to question whether we've got huge debt crises in the retail sector. And when that happens, as we know, it can turn into a global financial crisis. And that is really a significant event. We're not quite seeing that at this stage, although I do expect to see it over the next 1 to 1.5 years. All of these things will most likely tick up as people start to spend again. Forward PE, was it cheap to buy the Mag 7 on Monday? It was okay. We're about 28x at the time of this recording because, of course, we've seen a bit of a bump. But we got close to the 10-year median. And, of course, the 10-year median has been, in general, a very good buy zone for the buy the dippers. So we got pretty close, and that puts us in the perspective of where we're at. We also know that we generally expect 2 pullbacks a year, sometimes 3, and they are usually in the vicinity of 5 to 10%. We went negative 8% on the S&P. We went, of course, a lot more than that on the tech companies, and that is in line with some data we'll look at in a moment. So you can see here, year to date, 8% down. It's nowhere near as bad as some of the others have been. This is why people are often saying, well, we're going to see a secondary sell. We're going to see an absolute whipping of the market. Well, we did see that in semiconductors. And a lot of this has to do with this tantrum of how many rate cuts are we going to have. Now, we know a rate cut is most likely coming. The question is, how big is it? 50% or 50 basis points or 25 basis points? 134.5 basis points are now being priced into January 2025 contracts. And this means that we are faced with a recession or a non-recessionary outcome. Both are volatile into the event. Both are volatile 1 month after the event, which is why we think that we're going to have volatility through to October. And then we see what the market wants to do. Will we go into a non-recessionary period where markets go strong for the next 12 months? Or are we going into the cataclysm of something much, much more sinister, possibly up to 50 or 60% wiped off the markets? Well, one thing's for sure, you might think it's unusual what we just saw, but we know that in many of these cases, 2 months before the market actually gets a rate cut, which is, of course, July and August, because we know it's going to come in September, then we usually have a tantrum in some of these markets. Negative 8% is kind of the possibility. That's exactly what we hit. So we know that this is a real thing. We've been talking about it for a few days now. We also know that 1 month after can be quite volatile, so certainly expect that period to be the most negative, and then we'll figure out whether we're in this recessionary period or not. And 50 basis points might be one of the clinchers here. If we cut 50 basis points, it usually means the central banks, in this case the Fed, are freaking out. And if they freak out, then we know something could be happening more sinister within the markets. The last 2 50 basis point cuts led us into recessions. The other ones led us into boom times and then recessions often afterwards, especially 1998 and the 2019 cuts. Both of those ended up in recessions. It's just that it took a little bit longer. And I suspect that could be the one we're going for this time around. As we know, the VIX structure is absolutely incredible in terms of volatility. This is what happens in election years, although it's not quite going on that way. So we might have to get rid of that chart because it's not exactly following it. And we know that we're still in earnings season. So, of course, on Wednesday, we do have Disney, we do have Shopify, we have plenty of big companies, but a lot of them are not quite going as volatile as you would expect. Things like Reddit was expected to go plus minus 20%. I think it's about negative 4.5 or something after hours. And Supermicro kind of living up to it. It's about, I think, negative 13%. Announcing a stock split, trying to save its market cap share. It was not able to do so. Here's the dot points for Reddit if you want to pause the video and take a look at it. So generally speaking, I guess it looks pretty good, but as an IPO, it has to meet a lot of expectations. And Supermicro, again, had some amazing returns, but the market did not like what it saw in the forward guidance, I guess. So basically, gross margin declined 11.3% in Q4. They are expecting it to improve. Again, some dot points here if you're interested. Stock split could not save this stock, though. 10-to-1 forward stock split and still down 13% after hours. At times like this, I think it's really important to look at some of the bullish and bearish stats, but most importantly, look at ones that have been historically very accurate. And the Whaley breadth thrust has been one of the best. And of course, we mentioned this because it led into this idea that we were going to see weakness for the next 2, even 1 month after we got this cut or this thrust, which happened about 2.5 weeks ago now. And that then we generally do see bullish moves. Now, you may say, well, Time is different, everything is different. But do remember, we've got a couple of reads here. They go all the way back to the 1960s, and they have 100% historical accuracy with pretty decent bull runs in markets. In terms of dark pool liquidity, we've got more coming in our next show, but I thought this was an interesting one. Two massive trades on gold. Now, this is gold stocks. You can see here, iShares Gold Trust, two monster dark pool liquidity positions. Now, a lot of people are speculating that they're sells. I tend to not believe they're sells. I think people are starting to buy gold again. But yeah, massive trades here on gold. Usually those types of historically big ones tend to move big like markets and in the future. So that means that gold is going to probably start whipsawing quite a lot over the next coming weeks. Speaking of overall sector rotation, it's clipped here a little bit, but basically utilities is number one. Over the last 5 days, REITs, XLRE, usually you'd see that crashing if the economy was going poorly. XLP, XLC, XLV, a lot of defensives up the top, gold faring okay, and regional banks, metals, etc. down the bottom. Over the last 24 hours, again, we constantly see a lot of movement going into div stocks with the expectations of cuts coming. So we've got XLRE, we've got some banks as well, we've got utilities, all of those up at the top. But semis continue their very strong pickup. And we knew semis were the backpin of this market. They had to find base on Monday. They did. And again, we're seeing the advanced decline line on the S&P also improve. So things are starting to kind of pick up here. You can see on the daily, the advanced decline line also increasing. We hit into some interesting gap fill zones. We saw a rejection off that based on the Bank of Japan's statement. Of course, they are soft and they always do this. This is Central Bank 101. Oh, whoops, we stuffed something quickly. Knee-jerk reaction. We'll fix it, don't worry. Yeah, that's sending these futures up. But we suspect that we're getting bullish momentum anyway because we know that central bankers don't want to do the right thing for economies long term. They want to create sugar rushes. They want everything to be fantastic while they're running it and let somebody else deal with the problem in the future. This creates an interesting conundrum. We think that there's buyers here in the S&P 500. We're obviously looking very closely at the gap fills, and in particular, this one that comes from the Friday close, which is at 53.25. That could be a temporary bear zone over the next 24 hours. But what do the options suggest is going to happen here? Because we already know that in general, there's buyers around this market level. Well, if we have a look here, we're still in negative gamma territory. Everyone's loading puts. I mean, there's puts everywhere here. There's puts everywhere here. These are the next 2 days out. And we know even for the OPEX now in August, there are puts everywhere. So will it hold these levels? Well, we know 5,200 is going to be a huge turn point. So if we go under 5,200, we hold underneath there for lunch and continuing on after that part of the day, then there's a good chance that markets would continue to move down and really hit into where we were on Monday. But for now, it seems like markets are trying to stay above a lot of these puts and not pay them out. So yeah, there's a negative gamma situation going on here, but unless we see markets actually start to flow down, we don't really think that this is going to happen just yet. And we'll talk about that when we go through the NASDAQ and the Russell just later in today's show. Let's have a look at the CTAs now. As we suspected, absolute capitulation. That's exactly what a bull buyer wanted to see, because when they freak out like this, we know there's often a buy the dip just around the corner. That's an absolute freak out on the NASDAQ from CTAs. We also have a freak out, even more so on the SPX. Take a look at that dump. Bring it straight back down to neutral. Yep, someone got they got liquidated quite hard there. Gold CTAs dropping a little bit. Market obviously stabilized. Brent falling through the floor. Obviously Brent sitting on that big support we've talked about. And Tesla and NVDA, some interesting options going on here. Tesla's trying to hold above 200, which is where the put is this week, and 220 being the call. So we're kind of neutral between 200 and 220. We'll look at the charts soon. What about NVIDIA? Well, we know that NVIDIA filled the gap. Very nice. Sold off a little bit from that. And we continue to think that somewhere around that kind of 110 to 115 is probably the premium top for this week. So the markets most likely will not want to get through 115, which is that huge call level where we move into a positive gamma situation. And at the moment, they're holding up pretty well. So gap fill, nice work if you traded that one on NVIDIA. Although I do think it'll open up higher and probably move a little bit stronger into this Bank of Japan news. So let's have a look at the S&P 500 versus central banks. All the central banks are supportive of their current liquidity in markets. The VIX dropped off. I doubt we're going to get a 65 read again this year. That is an unbelievable read. It looks and smells like flash crash. And you can see here the big drop off in the VIX. If we go to the daily, you'll again see it coming down. Doesn't mean volatility won't come back up. In fact, we could actually go to a new low and we still will not see a 65 VIX. That is just so rare to see in these markets. Yields, they've all been picking up. So US 2, US 10-year yields. Treasuries hit first resistance and have sold off. And I would suspect that they're just going to float around for a while. Remember, treasuries are not an excellent trade, although we thought flows were coming into them based on last week. They are generally better for the longer hold. And we still think that 12 to 18 month holds will yield a 110, but it's going to be slow. So that's the problem with treasuries. They are slow, they are boring, they are great late cycle buys though, because you get paid to hold them. Plus, they are defensive if you're scared of the market. XHB, home builders, XLF, KRE, they're all rebounding. This is not a market that usually you would see doing well or doing okay in a full-on crash. So, of course, we continue to watch. We're open to those ideas, but we haven't seen it yet. What about our bonds indicator? Another day of recovery. Let's find out how that ends up going. Certainly a warning sign, though. And as we talked about in our Monday stream and also our videos here on the channel, guys, we talked about this idea that we should never forget this flash crash. If we go on to make all-time highs, one of the things I believe is this is a warning. This market is fragile, this system is broken, and debt is horrendous in the world. And eventually this will blow up. You know, a lot of bears out there in the comments saying this is it, this is going to explode. Historically, we see these types of events. A flash crash followed by big buy the dip buying that ends up in a new high, that ends up into we have fixed the system, guys. We will never crash again and everything is fantastic. It's when those types of things plus a yield uninversion occurs, we need to be absolutely terrified. And of course, if you follow this channel and keep following us, we'll be talking about this in the future because there are times to seriously panic and we believe that will be on the horizon. Right now, though, I still think that this market is showing the signs of knee-jerk reactions and policy changes that are trying to support something that's probably very sick underneath the hood. What about copper? Nothing much. Still floating around. We'll bring that up when it does change. Dollar index is recovering, which we expect it to do so as yields start to bounce back up. And again, we like a short up here for the dollar, but we're not there yet, so we'll keep watching that one. What about gold? 23.87, not faring that well on the last 24 hours. I mean, that's to be in some ways expected. It's held up very well. A lot of people think gold should fly to the moon when everything sells off. It's not quite what happens. People go with, oh, wow, it's holding up pretty well. Let's sell that and go into other risk-on assets, such as, of course, cryptos and, of course, the stock market. And that's exactly what's happening. 23.57, still a hold level. If we go lower, 23.20 is a very nice level for gold. And I think that we're still seeing a very, very nice movement moving forward on gold. And, of course, gold stocks, as you can see here, recovered over the last two sessions, even though gold didn't do much. So things are bouncing up. And it's fine in terms of our opinions. What about silver? Look, this continues. 26.50 was no joke. That's a serious level. We don't have a technical trade base yet for it, but you'll notice that somebody is trying to buy around here and it's just consolidating. We'll continue to watch that space. US oil trying to bounce off basically these low levels. This is a superiorly good investment grade zone for oil, and we know that this is where we could bounce. We saw some signs of potential recovery here. I didn't quite like that as a super good trade because it barely broke to a high. But if you did buy in here with stops below there, it is a valid trade. It's valid. It's not my favorite, but it is valid. If it now breaks above this kind of point, that is a good scale-in zone. And of course, we're expecting around 77, and then past 79, swing traders will come into oil. And at that point, we have to expect CTAs to be buying big time as well. HSI, the Chinese market, bounced. Still no day trade here, guys. And it is just a very deep pullback that could be an investment grade level. If you go to Tencent, which is our favorite stock to be looking at real recovery, it's holding, it's coiling. There will be a big move soon. I'm watching for it. We'll watch together. Semiconductors, nice bounce. Not quite into the gap fill for all the semis because, of course, some were reporting poorly. And it is still on its way to 229. Let's have a look at NVDA, though. This did fill gap. This is the strongest stock. This is the best stock. We've talked about it. 95 gap fill was a phenomenal level. Some of you guys were picking it up at 91. If you picked it up in the 104, 108s that we spoke about last week, you haven't even really lost at this point. So it'll be up in the pre-market too. So, one of the things here is that I guess it shows you quality, 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 and elastic demand. When you expect great levels, elastic demand comes into play. We've hit the gap. We are not at the 20 moving average on the daily, and this is probably the major level along with this zone here. So basically somewhere around 117, 115 to 117, like the options are saying, that's going to be the next bear zone, I would think, for this stock. And it hasn't had that 61.8 pullback. So we'll look for a pullback if the next session gives it to us. I doubt it will based on Bank of Japan's movements right now, but maybe a few sessions away. If we get a pullback, that could be a very good sign and opportunity for some people. As we suspected when we talked about crowd in the last video, we got a bit of a bounce. This could be a temp low for crowd. I don't think it's a great investment because, of course, they will have a lot of legal threats on them, but this is trying to get back to mean reversion. So somewhere around that 272 could be an interesting point for it. In terms of other stocks, things like Apple and stuff, actually inside candles, again, if they go bullish, can be quite bullish indeed for these stocks. So things are looking, again, a lot better than they were on Monday for the markets around the world. And in general, this is the type of thing that often you do want to see. We'll actually go back over here and we'll just have a look at Tesla. Now, Tesla was down, then it was up. Again, technically, it found that 61.8 pullback of the whole move. It found incredible dark pool activity trades that were there previously. And if you got in at the 180s, 185 basis, 188s, it all seems fairly decent for a rally for now. There are some problems with Tesla. We'll talk about it in an upcoming video. I think that there is going to be a possibility of a very bad earnings coming up, which we'll discuss. But let's have a look at some of the other markets, including the Russell 2000. Now, the Russell 2000 has been phenomenal. 20, 40, this zone here. And what does it mean by phenomenal is it hit a phenomenal zone. It's not that I necessarily suspected. I thought 2100 might find bid. It didn't. That was, of course, lining up. But once we got down to the key zone, this is the most traded, most important level. Now, we've found some buying pressure there. We're now starting to see some strength coming back through it, and we've actually seen a change of trend towards the upside on the small time frames. So effectively, all of this is being defended. It's very important this most traded zone, this defended zone does hold, and that spikes underneath are met by buy demand. A bear wants to see underneath here at all costs. A bull does not want to see back below 1975. That will be very detrimental. Again, time it well with those gap fills we talked about. NVDA may be the lead. Possibly that 115, 117 is a real possibility here. And also the US 500, 53.25 worthwhile watching. Let's move over to the Dow. No problems in the Dow. The Dow is looking incredibly strong considering how much we just went through. And of course, the NASDAQ is trying to find structure. So at this point, do we have a bounce? Yeah, we're holding that bull zone flip area. And we're trying to move into the gap fill, which ends up being just a few points above here. It kind of basically got it there on the previous session. And in general, at the moment, it is buying basically the Bank of Japan news. That's what's happening here. Some points to note on all of these major indices will be anchored VWAPs from the top down, and then also the 20 moving average if it does come back up to it, plus the trend line. I would say that the 20 and the trend line could hit with each other. And this is a no-joke trend line. So, of course, we'll watch that in our next video, something to be paying attention to. Let's now move over to cryptos, and we'll take a look at Bitcoin to start off with. It hit our monster level of 51 at 51.5. This is a huge zone. We've seen a bounce so far in the cryptoverse, and that is putting in a pretty strong weekly rejection. If it can hold this, of course, this has dramatic ramifications for all buyers out there. It looks like a wipe at this stage. No really good small time frame structure. And Ethereum did the same thing, hit a phenomenal level, and of course is bouncing this point. Generally expect Bitcoin to go first, so Bitcoin should be stronger than Ethereum in general terms. Although if you really put it in perspective, let's just go with how much Ethereum is down from its tops as a percentage. We take the top, we go to even this day, right here, 38.46%. It's no joke. That's a lot of money off. And from the top to the bottom, there's a 50% almost fall off, 48 there. So is this historically big? It's possible. This happens. This is how crypto is. Crypto does this, 60% here on Ethereum. But around that 30 for Bitcoin is a very decent, good pullback. That is a standardized one. And if you really think about it, about 42-ish% was about as much as you were going to get, which is 42,000. So for now, crypto is holding as well. For news ahead, really there's only one main bit of news, which is the unemployment claims number, which I don't think should move the markets that much on Thursday. The Bank of Japan, of course, coming out and saying, we're not doing anything, don't worry, we're not touching it anymore. That is the big news right now that's driving these markets. And in some ways, that's why we fell off. Of course, that was one of the three major excuses used by Wall Street, used by the media in terms of saying, oh, everything's blowing up. Well, as we've seen, that can reverse fairly quickly. It is a problem, but central bankers, they don't want anything to go down. If you enjoyed today's video, please remember to subscribe. Check out our newsletter. We've got one coming out for the open today, guys. I've got some charts. Obviously, we were looking for more stuff yesterday to see some structure, but we've got some great charts to share with you, so that'll be coming out today's open. And of course, follow us over on X as well. Thanks very much for watching. We'll see you in the next one. Bye for now.